Good evening, everyone, and welcome to our Understanding Pensions webinar. I try to host one or two financial education sessions each year on topics relating to personal finance, and I want to thank you for choosing to invest an hour of your time with me this evening. I'm confident that it will prove worthwhile as the next 60 minutes is packed with information and insights that I believe anyone would find beneficial when trying to better understand one of the UK's most common financial products, which is pensions. So, whether your retirement is just around the corner or still many years off, I hope after listening to this presentation, you'll see why I believe pensions are such a fantastic tool for retirement planning. A quick introduction. My name is Matt Burkitt, and I'm the founder of Burkitt Financial Planning, a family business that I run alongside my wife Claire, who is our practice manager, who's in the background manning the chat function as well. We established Burkitt Financial Planning 5 years ago because we believe everyone should feel confident and in control of their finances. We both really love our job and care deeply about our clients and are on a mission to bring clarity and confidence to the lives of the families we're privileged to work with. We aim to combine our distinct approach to financial planning with expert financial advice so that everyone we work with can achieve financial peace of mind. And we strive for our three values, as shown on the screen there, to shine through in everything that we do. Hopefully, during this webinar, you'll get a sense of how much we care about personal finance and the families we serve, the competence we have to ensure we're subject matter experts, and our ability to provide clarity on topics that many people may find confusing. A quick bit of housekeeping about the webinar. All attendees, as they log in, are automatically muted with cameras off. However, the chat and Q&A function is open. I understand that the content that I cover this evening is likely to generate questions, and I'd encourage you to send them through via the Q&A feature. However, I do have an awful lot to cover over the next 60 minutes, so I may not get a chance to answer the questions live this evening. Like I say, Claire is in the background monitoring the chat and Q&A feeds, and will make a note of any questions. If I can answer them live, I will follow up with you via email after the webinar. Alternatively, my contact details will be on the final slide, so you can get in touch directly with me afterwards as well. Whilst I have delivered numerous over the years workplace seminars on a wide range of financial education topics, this is actually only the second webinar that we've hosted. So we are keeping everything crossed that the technology is kind to us this evening. We chose the topic of understanding pensions as it's a subject that many UK adults find confusing and hard to grasp. Sadly, this often leads to people having low engagement with the pension plans, or even worse, not recognising them as a valuable tool for their future. Since pensions aren't typically covered as a topic in school, many people just rely on self-taught knowledge or advice from well-meaning but non-expert friends and colleagues. Yet pensions are a financial product that are vital for most people's retirement planning, hence the focus of tonight's webinar. So let's get cracking. Perhaps the best place to start is to confirm what a pension actually is. And at its most simple level, a pension is just a long-term savings vehicle with tax benefits. Most newer pensions are honestly quite straightforward. There are older pensions, though, particularly those from the late 80s and 90s, that have more complicated features that you need to watch out for. But nowadays, pensions tend to be much simpler. So, if that's what a pension is, why are they so confusing? Well, on the screen that is about to appear in front of you, there are names of many different pensions that you might come across, and this isn't even an exhaustive list. With such a huge variety of different types of pension, it's no wonder people often feel overwhelmed by them. So let's start to unpack this a bit. Despite there being so many names for different pensions as shown on that previous screen, there are actually only two main types. Firstly, a defined benefit pension. These are also commonly called final salary schemes, or more recently, career average revalued earnings schemes. A bit of a mouthful, and therefore the acronym CUR is sometimes used to replace it. This type of pension offers a promise of future defined income. The benefit you'll be able to access can be calculated and therefore is known or defined, hence the name defined benefit. There's no pot of money that belongs to you in the background. Instead, you are accumulating an annual pension that will be paid to you, a bit like the continuation of your salary. These pensions are often referred to as the gold standard of pensions because of this promise of a guaranteed source of income in retirement. And what's more, all the risk for paying this benefit for the rest of your life sits with the scheme and your employer, not you as a member, which is fantastic for you as the member, but perhaps not so great if you're the employer. And that's why defined benefit schemes are now mostly a preserve of the public sector. Most large employers in the private sector have stopped using defined benefit pensions because they are very expensive for employers to run. In fact, I honestly can't think of any private sector companies that still have this sort of pension scheme available to new members. Even in the public sector, the benefits available from these types of scheme have been watered down to make them more affordable. The alternative type of scheme is a defined contribution pension. With these plans, you do not know what the benefit you are going to have access to is in retirement, but you do know how much you are paying in and how much your employer is paying in. The contribution levels are defined, hence the name defined contribution. They are also sometimes referred to as a money purchase pension. This is because you build up a pot of money throughout your working life, and when you come to access it, you may choose to use the funds to purchase another type of financial product, for example, an annuity. In its simplest form, a defined contribution pension is just a savings account with great tax advantages. So just think of it as a pot of money you are building up with brilliant tax benefits. That's the headline description of the two main types of pension. I'll now take each of these types of pension in turn and talk about them in a bit more detail. So let's start with defined benefit pensions. As I mentioned on the previous slide, what makes defined benefit pensions so good is that they are a promise of future guaranteed income. And let's face it, when you retire, one of the biggest concerns is no longer having a regular income landing in your bank account each month. So to have this replaced by defined benefit pension offers a great deal of peace of mind, particularly as it is your former employer's responsibility to pay it to you for the rest of your life, no matter how long you live. These days, like I've mentioned, they are mostly the preserve of the public sector, so employees in the NHS, police service, fire service, armed forces, teachers and civil servants will all have access to a defined benefit pension. Although, if you have worked for a large private sector company like a bank, you may have accumulated benefits within a defined benefit pension, even if you are no longer an active member of the scheme. I've already mentioned this type of pension is more commonly referred to as final salary or career average. The reason for this is because your salary has a bearing on what the benefit will be that you receive in retirement. Whilst all schemes will have subtle differences on how your future benefits will be calculated, the three parts of the equation will be your pensionable pay, an accrual rate, and your length of pensionable service. So just to bring this to life for you, let's say your pensionable pay is £60,000 a year, and your pension scheme has an accrual rate of 1/60th. This means you accrue 1/60th of your £60,000 salary for every year you are an active member of the scheme. So, if you work for that employer for 20 years, you would accumulate 20/60ths of your £60,000 salary to be paid at the scheme retirement age. Using this example, 20/60ths of £60,000 would equate to an annual pension of £20,000 a year for the rest of your life. Some older defined benefit schemes may also have a built-in tax-free lump sum, meaning you receive a lump sum at your retirement age, as well as your annual pension starting to be paid. Each scheme will have a quoted retirement age. This is the age at which you can access your pension benefits without penalty. For example, if the scheme retirement age is 65, you can retire at this age and take the benefits quoted in your annual benefit statement. However, you are legally allowed to access a pension from age 55 at the moment. This is increasing to 57 in April 2028. As such, you are able to retire and take your benefits before the scheme retirement age. For example, if the scheme retirement age is 65, but you wanted to retire at age 60, you could do this. However, if you do access the benefits before the scheme retirement age, they will apply an early reduction factor to your benefits. In other words, you will receive a reduced annual pension. The earlier you retire before the scheme retirement age, the higher the reduction factor applied to your pension benefits. It is also worth pointing out that it is very common for defined benefit schemes to have different sections, all of which might have different scheme retirement ages, which means if you have worked for an employer for a long time, you may have accumulated benefits in different sections of the scheme. For example, the oldest section of many public sector pensions has a scheme retirement age of 60, whereas since 2015, the newest section of public sector pension schemes will have a scheme retirement age linked to the member's state pension age. As such, an employee may have benefits accumulated that they could take from age 60 without penalty, but also have some benefits that, if taken before the state pension age, may have early reduction factors applied. It's definitely worth reading your benefit statements to make sure you are clear on what the scheme retirement age is and whether you have benefits accrued in different sections of the scheme. Another fantastic feature of defined benefit pensions is that you benefit from something called indexation. This just means the benefits you have already accumulated are uplifted each year in line with an inflationary measure. For example, the scheme might use the Consumer Prices Index, known as CPI, as the measure to determine the level of inflationary increase to apply to your pension. The idea behind indexation is that these inflationary uplifts help to maintain the purchasing power of your money over long periods of time. You also benefit from these inflationary increases even if you are no longer a contributing member of the scheme, and also when you're in retirement and drawing on your pension. Each defined benefit pension scheme will have terms and conditions for the death benefits they pay. The death benefits your loved ones may receive may differ depending on whether you die before you start drawing the pension or if you die whilst the pension is in payment to you. It's really common for a spouse to be able to access 50% of the annual pension benefit if the member dies. Understanding your pension's death benefits is important, as if as a couple you have built your retirement plans on one of you having a very good defined benefit pension whilst the other spouse has very little in the form of retirement provision, you may want to consider what the consequences would be if the person with the defined benefit pension dies first. Finally, just to confirm some language you may come across relating to the membership statuses of these schemes. There are three categories of membership: an active member, a deferred member, and an in payment member. An active member refers to someone who is still contributing in the scheme as an existing employee. A deferred member refers to someone who used to be an active member but is no longer actively contributing into the scheme. For example, they may have left the employer to take up a new job somewhere else. As a deferred member, the benefits accumulated up to the point of you leaving are preserved in the scheme so that you can access them when you reach your retirement age. And finally, an in-payment member refers to someone who is retired and in receipt of their pension benefits. I thought it might be useful to show an example of a defined benefit pension statement. You'll see they will normally provide a date for which the benefits quoted relate to. In this example on the screen, it's saying that these benefits should be available if the member retires on the 1st of March 2025. A statement a statement like this will normally provide two options. The standard option, in this example listed as number one, which is saying that the member could start accessing just over £14,800 a year from the 1st of March, but will not receive any tax-free lump sum. It also provides an option if the member wanted to take the maximum 25% tax-free lump sum, which is available to them. So option two shows they could take approximately £72,500 on the 1st of March up front as a tax-free lump sum, but this would reduce their annual pension to around £10,800 a year. And at the bottom of this example, it also quotes what the death benefit would be for the spouse or civil partner if the standard option was taken up and then the member died whilst in retirement. The surviving spouse would be paid a dependence pension of just over £8,000 a year for the rest of their life. So hopefully, over the last two slides, that's provided you with a much better understanding of defined benefit pensions. Now let's move on and look in a bit more detail at defined contribution pensions. Defined contribution pensions are now the most common type of pension. All personal pensions are defined contribution plans, and nowadays, certainly in the private sector, the majority of workplace pensions are as well. With this type of scheme, you are accumulating a pot of money that you can use in the future to support your income needs in retirement. The aim is obviously to build a pot that's big enough to fund the type of lifestyle you want to live when you are no longer working. The money you and your employer pay into this type of pension is invested with the aim to increase in value over time. This isn't a webinar on investing, however, I will briefly touch on investing a bit later on. The key thing to note is that the eventual size of your pension fund will be determined by how much you've contributed into your pension, as well as the investment returns you have experienced during that period. Do you know how your defined contribution pensions are invested? And when was the last time that you reviewed them? Two questions for you to consider. The normal minimum pension age is currently 55. This is the age at which you can access your defined contribution pensions. They do not have early reduction factors applied to them like defined benefit pensions. As I mentioned earlier, though, the minimum pension age is increasing to 57 in 2028, and it is planned that the minimum pension age will then be 10 years below the state pension age from this point forward. So, for example, if the state pension age increases to 68 in the future, then the age at which you can access your personal and workplace pensions will increase to 58, so that 10 years below. You may, however, see a retirement age quoted on your defined contribution pension statements. Why is this necessary if you can access them from the minimum pension age, though? Well, the retirement age quoted on your plan is used for a variety of things, one of which being to provide you with a projection of what your pension might be worth in the future. So, if the retirement age stated on your plan is 65, when they provide you with an estimated future value, it will be quoted to this age. The retirement age listed on the plan is also used to determine changes to how your pension is invested if you are part of a lifestyling investment strategy. This is something, again, I'll explain a bit later on in the webinar. It is very common for people to have multiple defined contribution pension plans, particularly as it's now rare that you remain with one employer all your career. Each time you start a new job with a new employer, it is likely you'll be enrolled into another pension plan. And over a 40-year career, this can make keeping on top of your pensions increasingly challenging and is a reason many people opt to consolidate pensions to reduce the number of plans they have. Consolidating can be very beneficial as it's not uncommon to lose track of all pensions. This can be even more of an issue if you move house and don't update your old providers on your new address details. It's always worth considering taking advice from a suitably qualified professional before proceeding with any consolidation, as some older defined contribution pensions might have valuable guarantees or safeguarded benefits that will be lost if you transfer from that scheme. Perhaps one of the biggest differences between defined benefit and defined contribution pensions are the options you have when you reach your retirement age. There is much more flexibility when you access a defined contribution pension, but with this greater choice comes potentially added complexity. Again, I'll talk through different options a bit later on in the webinar. Usually, if you die, the remaining funds within your defined contribution pension can be passed on to your loved ones, whether that be your spouse, children, or other family members. However, the death benefits are not governed by your will, so it is important to make sure you have an up-to-date nomination of beneficiaries form logged with each of your pension providers, so they are clear on what your wishes are for your pensions if you were to die with money remaining in them. To complete the overview of defined contribution pensions, I wanted to show an example statement for one of these types of pensions too. As you can see, it's notably different to a defined benefit pension statement. The statement provides a current plan value, in other words, how much this pension pot was worth on the 13th of November, but it clearly points out that this isn't guaranteed and the value could go up and down in line with the value of the underlying investments. The transfer value indicates how much would be transferred if you were to move your pension to another provider. Usually, the transfer value will be the same as the current plan value. However, if these values are different, this will usually be due to either exit penalties or loyalty bonuses that would apply to the transfer. So this is something to be aware of if considering consolidating your pensions. The statement will also confirm how your pension is currently invested. In this example, you can see that the money is split between two fictional funds, with around 80% invested in the ABC fund and the remaining 20% invested in the XYZ fund. On your pension statements, it might show you're invested in one fund or multiple funds, and you will be able to access or request the fund fact sheets from your existing pension provider. I said right at the start of the webinar that in the simplest form, pensions are just an extremely tax efficient savings vehicle. So let's have a look at the tax treatment. When you pay into your pension, some of the money that would have gone to the government as tax goes towards your pension savings instead. This can help reduce the amount of tax you pay and be used to help boost your savings for the future. This tax relief is given based on the rate of income tax that you pay. So if you're a basic rate taxpayer, you get 20% tax relief. A higher rate taxpayer gets 40% tax relief, and an additional rate taxpayer can get 45% tax relief. Tax relief is one of the key reasons why pensions are such a fantastic financial product. Do you know of any other savings vehicle that gives you a return of 20% or more? Once your money is inside your pension, it grows free from income tax and capital gains tax. Again, an amazing benefit for long-term investors, as it means you retain more of your growth and the investment returns. When you come to take money out of your pension, you can take 25% tax-free, with the remainder taxable at whatever your tax rate is at the time of retirement or at the time of drawing on your pension. In retirement, your tax rate may be lower than what it was when you were working because you have a lower amount of income. And combined, these things really do add up and make pensions an incredibly efficient way to save for your retirement. Furthermore, if you're a member of a workplace pension scheme, you will also benefit from your employer making contributions into your pension too, something they are unlikely to do for any other type of savings account. To bring this to life, let's look at a very basic example of tax relief in practice. You're a basic rate taxpayer and decide to make a £100 personal contribution into your pension. This contribution benefits from basic rate tax relief, meaning the pension provider claims this rate of tax back on your behalf. Therefore, even though £100 left your bank account, you would actually have £125 invested into your pension. Not a bad automatic uplift, I think you'd agree. And even better, if you are a higher or additional rate taxpayer, you may also be able to claim further tax relief back. Additionally, if your employer was to match your £100 contribution, you could end up with £225 going into your pension, despite you only contributing £100 yourself. There are three main ways you can contribute money into your pension, and I'm now going to spend a bit of time explaining each of these methods. The first of these is via something known as the net pay arrangement. This is where your pension contributions are made before you are taxed. In other words, out of your pre-tax or gross pay. Your employer deducts the full amount of your pension contribution from your pay before any tax is deducted. This means you pay tax on your earnings minus your pension contributions. As a result, your tax bill will be lower. Although you've paid the full amount of your pension contribution yourself, you get the tax relief straight away because you're paying less tax. As the table shows, if you are making a 5% employee contribution into your pension, this would equate to £125 a month on a £30,000 annual salary. Your employer would deduct this £125 each month before any tax was calculated and pay this into your pension. As such, there is no need to claim tax relief, as you have already benefited from it by paying no tax on that part of your salary. If you had decided not to pay the £125 into your pension and instead got it paid into your bank account from your employer, you would have been taxed on it. The second way that contributions can be made into a pension is via relief at source. With this method, your employer deducts the tax from your taxable earnings as normal. They then send your pension contribution from your after-tax pay to your pension provider. Your pension provider will then claim 20% in tax relief direct from the government on your behalf, which they add to the pension pot. The table on the screen there, the blue line, helps to illustrate this difference between these two methods. To make the same £125 contribution via relief at source, you would actually make a £100 contribution from your after-tax pay, with the pension provider then claiming the £25 worth of tax relief, which is also added to your pension. So you get the same result, £125 going into your pension. It's just how you get the tax relief is slightly different. If you are self-employed and have a personal pension, you will always use the relief at source method. However, some workplace pension schemes also use this method for their employees too. And it is important to understand which of these methods is being used for your pension, particularly if you are a higher rate taxpayer. As if you are a higher rate taxpayer, you will have to claim the extra tax relief yourself through a tax return. You don't have to do that if you're using the net pay arrangement. The final way of contributing money into your pension is via salary sacrifice. This is perhaps the most tax efficient way to put money into your pension. However, you must understand this means entering into a contractual agreement with your employer to lower your salary. If you had taxable income of £80,000 from your employment, this would be liable to income tax and employee national insurance. Plus, your employer would also need to pay employer national insurance on these earnings. However, if you entered into a salary sacrifice arrangement whereby you lowered your salary to £75,000 and your employer instead paid the £5,000 directly into your pension as an employer contribution, this would mean income tax and national insurance would only be applicable on £75,000 worth of earnings rather than £80,000. And it's this what makes it really tax efficient and more tax efficient than the other two methods outlined because you're saving in both employee and employer national insurance contributions. Some employers might be really generous and might pay the saving they make on the employer national insurance into your pension too. But be aware that lowering your salary could have some disadvantages. A couple of examples include if your employer provides you with life cover, this is usually a multiple of your salary. Therefore, a lower salary as a result of salary sacrifice would mean a lower death in service benefit. Additionally, a lower salary might affect the amount of money you're able to borrow for a mortgage. So it is just worth considering if you are going to enter into a salary sacrifice arrangement. I've just spent some time explaining the three ways you can make personal contributions into your pension. However, if you are the director of your own limited company, then you may consider making contributions directly from your company. So let's have a quick look at how this works in practice. So, as a business owner, you generate revenue for your business by selling your products or services. You can then deduct any allowable expenses from this revenue, so things like wage bills or the costs of making the products, etc. And this then leaves you with a level of profit within your business. And this profit is liable to corporation tax. However, let's have a look at the difference if you decided to make a pension contribution from your company into your pension. So in this example, you've got exactly the same total revenue for the year, plus the same allowable expenses. However, the company pension contribution would also be classed as an allowable business expense. This has the effect of reducing the profit within your company, meaning a lower corporation tax bill, providing a really tax efficient way to extract money from your company if you are running it as your own company director. Let's switch the focus now to how much to put into your pension. And I'm going to look at this through a couple of different lenses. So I'll start with the minimum legal requirements under automatic enrolment. So since 2017, all employers have to offer a workplace pension scheme and automatically enroll eligible workers into it. The minimum total contribution value that must be made under automatic enrolment is usually 8% of an employee's qualifying earnings. You can see what constitutes qualifying earnings on the slide there. Your employer must contribute a minimum amount, and in most cases, this is 3%. However, this is a minimum, and your employer may decide to contribute a higher amount than this. However, if the contribution from your employer isn't enough to cover all of the minimum 8% total contribution, you'll need to make up the difference. As I've already described, the government will also help you save for your pension by giving you tax relief on your contributions. Note, qualifying earnings are different to your pensionable pay. So, if you were earning £60,000 a year and have 8% of qualifying earnings contributed into your pension, this doesn't mean 8% of £60,000. It means 8% of everything over £6,240 and up to £50,270. In other words, not the bit below the 6,240 and not the earnings you have above the 50,270. Whereas if your contributions are based on your pensionable pay, the 8% contributions would be based on your entire £60,000. Again, this is something to be aware of, as you may think you are saving more than you actually are into your pension. And I have come across this before with people who thought they were saving 10% of their salary into a pension, and they weren't actually doing that. It was 10% of the bracket of qualifying earnings. So it is just worth checking on that. Employer contribution matching is when an employer agrees to pay more into an employee's workplace pension, as long as the employee increases their own contributions. Taking advantage of additional employer contribution matching helps you build your retirement savings faster, but you just need to make sure you can afford to pay more in if you're increasing your own personal contributions. Your employer might match your contributions up to a certain limit, and this is usually stated as a percentage, maybe in your work contract. For example, if an employee increases their contribution by 1%, the employer might also increase their contribution by 1%, but only up to a maximum limit. So let's take a look at an example. So Matt earns £40,000 a year and is a member of his employer's workplace scheme, and he currently contributes the minimum amount into his pension. He's lucky his employer contributes more than they have to at 5%, but Matt just makes it up to the 8% minimum level by contributing 3%. However, he finds out that his employer is willing to match his contributions up to a maximum of 8% of his salary. So he makes the decision to do that and adjusts his own personal contribution up to 8%. And his employer does exactly the same thing to match it. So you can see here, if you look at the purple line on the graph, he's now getting £100 a month more from his employer, which is free money ultimately, because his employer wouldn't have been paying it to him if he hadn't increased his pension contribution. It's well worth looking at what the maximum match contribution is from your employer to see whether you're taking advantage of it. Now, if we look at how much can be put into a pension, there's actually no limit on the amount that can be saved into your pension each tax year. However, there are limits on the amount that can be saved into a pension each tax year to benefit from tax relief. So the tax relief that I was describing earlier on in the webinar. If you put in above these limits that I'm about to talk through on this slide, a tax charge might apply to reclaim the tax relief that's been given to you. So what are the limits? So firstly, any contributions made by you or someone else on your behalf must be equal to or less than your relevant UK earnings for the tax year in which they are made. Now, relevant UK earnings are a type of earning that attracts tax relief and include quite a few things, but the main one really is your employment income. So things like your salary and bonuses are classed as relevant UK earnings. So if your earnings were a £30,000 a year salary, then this would be the maximum you could put into a pension in the tax year to benefit from tax relief, because that would be 100% of your relevant UK earnings. If you have no earnings or earn less than £3,600 in the year, you can still put money into your pension, for example, by using money from your cash savings, but it is limited to £2,880. If you earn more than £60,000, then your total pension contributions are capped at this amount, even if your relevant UK earnings are above this level. This is known as the annual allowance. For defined contribution pensions, this includes the total of all your personal contributions plus any tax relief added to your pension, any employer contributions, and any contributions made on your behalf by someone else. For defined benefit pensions, the annual allowance used is based on how much your pension has increased in value over the tax year. If you are a very high earner with income above £260,000 in a tax year, then you may not have an annual allowance of £60,000. The annual allowance is reduced based on the level of earnings you have above £260,000, and this could result in being limited to £10,000 worth of pension contributions in a tax year. This is called the tapered annual allowance, because the annual allowance is tapered down from the usual or standard £60,000 to a minimum of £10,000 based on your level of earnings above the £260,000 threshold. However, you may be able to carry forward unused annual allowances from the previous 3 tax years, allowing you to put more in than the current year's allowance if your situation allows. So, for example, if you got a large bonus in a particular tax year. It is also worth noting that if you begin to access a defined contribution pension, this might trigger something called the money purchase annual allowance. So this lowers the amount you can put into a pension to £10,000 for the tax year. Now, this might not be a problem if the reason you've accessed your pension is because you've retired. However, if you've accessed your pension and have carried on working, and your intention is to continue contributing into a pension, then it is something to be aware of. All the previous boxes relate to how much can be put into a pension each tax year, but is there a lifetime limit to how much can be accumulated in your pensions? There used to be. This was known as the lifetime allowance, and it was just over £1 million. However, the lifetime allowance was abolished on the 6th of April this year, meaning there would no longer be a tax charge for the value of your pension above this circa £1 million limit. Despite this having been abolished, the old lifetime limit does still have some relevance for how much tax-free cash can be taken from your pension and for the level of pension death benefits too. I did say earlier in the webinar that I would briefly come back to investing. This is relevant for defined contribution pensions where your money is invested to help grow your pension pot. The money you pay into a pension is used to buy things. Now, these things are called assets in the financial industry, and assets could include equities, which are shares in companies, bonds, which involves lending your money to governments or companies, commercial property, alternatives such as commodities like gold, or even retained in cash. How your money is split between different assets is known as your asset allocation, and this really does have a significant bearing on the longer term returns as well as the shorter term fluctuations that you may experience throughout your time investing in a pension. Many people make no active decision on their asset allocation and are instead invested into the default fund of the provider. And this may or may not be right for your own retirement objectives. A key factor for anyone's investment strategy will be the percentage of your pension invested in equity-based assets. So equities will be the growth engine for your pension long term. But as an asset class, equities are also likely to result in greater fluctuations in value, known as volatility, over shorter periods of time. You may also want to ensure you have the right level of diversification for your investment strategy. So, for example, if you have an equity allocation of 60%, as shown in the pie chart, what proportion of this is invested in UK companies versus companies from other parts of the world? Is your pension diversified enough? I referenced lifestyling earlier in the presentation. This is a predetermined investment strategy implemented by your pension provider based on your chosen retirement age. It means the asset allocation for your investment is automatically adjusted on your behalf. The further away you are from retiring, the more equities you'll be invested in. The closer you get to your selected retirement age, the less equities you'll be invested in. Lifestyling can be a good feature, but for many people, it isn't always a great solution, particularly if you intend to leave your pension invested throughout your retirement as you draw an income from it, because your retirement may actually last 2 or 3 decades. But if you have been moved into an asset allocation that doesn't offer the prospect of higher longer term returns, you may find you run out of money quicker. Many people do not appreciate the concept of compound growth, and this is what makes investing such a fantastic wealth building strategy over long periods of time. Simple growth offers a steady increase at a constant rate over time, whilst compounded growth is the process of reinvesting growth from previous years to generate additional earnings. The key to compounding is reinvesting your returns back into your pension over long periods of time. And I'm going to help you visualize this over the next 2 slides. Let's start with a basic example of simple growth. This refers to earnings growth only on the initial amount that you invested. On this example, the contributions are shown in yellow and you make a £100 contribution. Now, if you earned a 4% growth on that original contribution, this would equate to £4, and that's shown in green on the slide there. If you withdraw the £4 growth each year, then the 4% return that you are generating is only ever on the original £100 invested. The bit in pink shows the amount that would have been withdrawn each year. By the end of the 5-year period shown in this slide, you'll see the total return is £16. The original £100 plus 4 lots of £4. Let's compare this to compounded growth. Exactly the same chart, just this time the £4 is reinvested each year rather than withdrawn. This means instead of getting a a 4% return on the original £100 invested, you would also be getting a 4% return on the previous year's growth. You can see that each year the growth displayed in green is increasing at a faster rate. So instead of a return of £16, the return would be £16.98 in this example. Now, I get that these numbers don't sound very significant, but that's in part because it's just a very basic example that I've used to bring this to life. Over long periods of time, such as a 40-year career, and with contributions that are likely to be well in excess of the £100 a year shown in this example, compounded growth can have an enormously positive impact on your eventual retirement. To bring this to life a bit more, take an example of you've opened a pension and you've made an initial £10,000 investment, followed by ongoing £400 a month contributions over a 40-year career. And in this example, I'm using a 5% a year rate of return. Column 2 shows the amount you'd have contributed into this pension after 40 years. You can see here at the bottom of column 2, £202,000 would have been put into the pension. However, because of the power of compounded growth, you'd have benefited from over £480,000 of growth, meaning despite having only contributed close to £200,000, you'd have a pension worth not far short of £700,000. This is purely used for illustrative purposes, but I hope it reinforces the power and importance of compounded growth. And while you want to use it in your favour, planning for your retirement is absolutely essential. When you get to retirement with a defined benefit pension, your options are pretty limited. You begin drawing an annual pension and make a decision on whether you take a certain level of tax-free cash as a lump sum. Whereas with your defined contribution pensions, the options at retirement are much more varied. Now, I'm going to explain these options, but just before I do, you may come across the two words shown on the screen here on your paperwork, uncrystallised and crystallised. They may sound complicated, but it is just financial jargon to describe whether the pension has been accessed yet or not. An uncrystallised pension is a pension that has not been accessed in any way yet, whereas a crystallised pension is the opposite. It refers to a pension you have started to access. So, during your working life, you are building up uncrystallised pension funds. When you reach retirement with a defined contribution pension, you have a number of different options on how you can access these funds. You could decide to purchase an annuity, and this involves exchanging your pot of money for a guaranteed income. For example, say you had £100,000 in your pension, you could approach an insurance company and obtain an annuity quote. They would use several factors such as your health to ultimately make an assessment of your life expectancy, and this would allow them to provide you with an annuity rate. This will be a percentage. So, for example, if they offered you an annuity rate of 4%, in exchange for you giving them your pot of money, they would pay you 4% of this value every year for the rest of your life. So, using the example I said before, if you have a £100,000 pension and you get a 4% annuity rate, this would mean being paid £4,000 a year for the rest of your life as an annuity. Another option is that you could cash in the whole pot in one go. However, bear in mind, if you were to do this with a larger pension, you may end up with a significant tax charge because only 25% of it would be tax-free. You could take smaller lump sums from your pension at times to suit you. For each one of these lump sum withdrawals, 25% would be tax-free and the other 75% taxable. For example, if you had a pension worth £200,000, you could take £20,000 out of your uncrystallised pension, leaving the remaining £180,000 in that uncrystallised pension. And out of that £20,000 small lump sum that you've withdrawn, £5,000 of it, so 25%, will be tax-free. The other £15,000 will be added to your other taxable income in the tax year and will be taxed accordingly. Don't ask me why, it's jargon, but the industry call this uncrystallised funds pension lump sum, or UF+. You could take your full 25% tax-free cash right at the start when you first retire and then move the remaining funds into a drawdown account. From here, you can access them flexibly as you need them. For example, if you had a pension worth £200,000, you could take £50,000, so the 25%, as a tax-free lump sum. This is called your pension commencement lump sum. The remaining £150,000 would then become a crystallised pension and be held in a drawdown account. You could leave it there invested in this account until you need to access it and then set up regular withdrawals. But remember, any money taken out of the drawdown account is potentially taxable if it's above your personal allowance. Finally, you could do a combination of these options. For example, you could use some of your uncrystallised pension funds to purchase an annuity, a guaranteed income, and then access the remaining funds flexibly. To finish off, I just want to talk about the state pension. So it's the state pension is a state provided guaranteed income for life, which rises each year in line with an inflationary increase. And before the 6th of April 2016, there was a basic state pension. And from this day onwards, it became the new state pension. I'm just going to concentrate for the purposes of this on the new state pension, which is what the majority of people on this call are likely to access. So, the new state pension, just some of the headline information on this. The state pension age is currently 66 and is rising to 67 in 2028. To be eligible for the new state pension, you need national insurance credits for at least 10 years, 10 full years. To get the full new state pension, you need to have 35 full national insurance years. So how much is it? Well, in the current tax year, someone in receipt of the full new state pension will be getting £221.20 a week, which equates to about £11,500 a year. And this is rising next April to nearly £12,000 a year, so about £1,000 a month. So it's a brilliant benefit to have access to in the future. The new state pension is based solely on your own national insurance record. It cannot be inherited from your spouse or civil partner. If you have any gaps in your record, you can make voluntary national insurance contributions to plug these gaps. For example, if you're unlikely to get to the full 35 years. And it is worth noting that whilst most people will accrue their national insurance record through working and paying national insurance, this isn't the only way your national insurance record can be built. For example, you can be credited for national insurance if you've not been working due to raising children. There is criteria around this, such as being in receipt of child benefit and having children under the age of 12. You may also be able to claim national insurance credits if you're out of work and in receipt of certain benefits like job seekers allowance, or if you're a carer in receipt of carers allowance. The state pension is a very, very valuable benefit and it's the backbone of many people's retirement plans, so it should be something you take the time to understand. So let's finish off with some top take-home actions for you as a result of this presentation. So firstly, get a state pension forecast. This will ensure you understand your state pension age and your forecasted benefits. You may spot gaps that need to be queried, and you can do this via the gov.uk website or via your government gateway account if you've got one. Secondly, dig out all your pension paperwork and create a list. Write down the name of each provider along with the plan number and the most recent value. Also, you might want to add the name of the employer you think this pension relates to or each pension relates to. Can you spot any gaps? Also, on the paperwork, check that your details look correct. Is your address still up to date? If you've got married, is your surname correct? If anything is inaccurate, contact the provider to update your details. Thirdly, look through that list once you've done it and consider, are there any gaps? For example, you may have worked somewhere, but you haven't identified a pension from your time working there. If you believe you're missing a plan, give that employer a call or use the pension tracing service via the gov.uk website. It's important to understand your pensions. For example, how are they invested? Does the investment strategy align to the level of risk that you're comfortable taking? When did you last properly review your pensions? Is a lifestyling strategy applied, and is that right for your situation? Check that the correct beneficiaries are listed on your pension provider or with your pension provider. Remember, Pensions aren't governed by wills, so you must make sure you've got the correct nominated beneficiaries. And then finally, you may also benefit from speaking to a financial advisor to help with reviewing your pensions, but also to assist with developing an overarching financial plan for your retirement. I'm more than happy to set up a call with anyone who feels this would be beneficial and to have an initial chat. I hope you found the content useful and interesting. And thanks once again for investing an hour of your precious time with me this evening. You can see my contact details there on the slide. I'm more than happy to set up a phone call or video call if you've any questions or if you'd like any support with your retirement planning. Just get in touch.